Welcome back. You are watching the Oasis Focus and Finance show, and we are talking tax in October. Currently, we are discussing our second category in the show, and that is pre-retirement savings. Hugo, Naweed has already outlined the whole retirement annuity landscape, but how do we understand deductions from a retirement annuity?
Well, the deduction that you enjoy for your contributions to a retirement annuity is limited to the greater of R1,750, R3,500 less any contribution that you got to the pension funds, and 15% of income other than your income from permanent employment. So if you have a second house that you're renting out, the 15% deduction will be based on the income that you receive from that. If you do not have a second or non-retirement income, there's no real tax benefit to taking out a retirement annuity. So it is important that you look from it from a financial point of view, and that you bear in mind that once you start contributing to these retirement annuity funds, you cannot access those funds until the day you reach the age of 55. So before you start down this for a tax path only, consult with your financial advisor to make sure that it's the best financial decision from you, not necessarily from a purely tax point of view. National Treasury is in the process of changing the rules applicable to retirement funds to try and align the tax consequences and treatment of retirement annuity funds, provident funds, and pension funds. Now, these rules will become applicable from 1 March 2016, and as of that date, provident fund clients will no longer be able to access their entire provident fund savings the day that they retire. Just like pension funds and retirement annuity funds, they will be required to annuitize 2/3 of that. Bear in mind though that this is only applicable to retirement or provident fund contributions that you made after 1 March 2016. So anything before that date you can still access upon retirement.
Right, Naweed, Hugo has been talking about these changes. Can you just expand on it just a bit?
Shafiq, the proposed changes to the retirement fund is actually called the Retirement Fund Reform. And what this aims to do is actually to align the deductibility aspect. So earlier I told you where with the pension fund you're allowed to deduct the contributions, whereas provident funds you can't. So going forward in future, it's going to align these. So provident fund members will also be able to deduct the contributions made into the provident fund. One thing that you must be warned about, or the viewers should be warned about, is that any contributions made by your employer, this will be treated as a fringe benefit. However, you will be allowed to deduct this from your taxable income. The overall deduction, in other words, the total contribution into a pension fund, provident fund, and retirement fund will be limited to the lesser of 350,000 Rand and 27.5% of the higher of your remuneration and taxable income. These changes are not applicable as yet. As Hugo said, the proposed implementation date is the 1st of March 2016. But again, Shafiq, we always tell people, please consult with your tax advisor to make sure that the correct deductions are made so that you best benefit from these allowable deductions.
Right, Hugo, there's another issue. At some stage in our lives, we change jobs and we can get access to our pension funds. In other words, we can withdraw from them. But there are tax consequences, aren't there?
Yes, indeed there are. When you withdraw from your retirement fund pre-retirement, you're allowed to access the funds, but there are tax consequences to consider, like you correctly said. And not only that, you also need to bear in mind that you are tapping into your retirement savings, and at that stage, as a result of the time value of money, that asset, your retirement savings that you're taking out, is a very valuable asset. And if you take a lump sum portion when you withdraw from the fund, it's not only disadvantageous from a tax point of view, but also from a wealth point of view. Preserving your retirement fund simply means that you transfer your retirement savings into a preservation fund, or you can even transfer it into the retirement fund of your new employer, or even to a retirement annuity fund. If you transfer the entire retirement savings amount upon withdrawal when you change jobs or you've been retrenched, there's no tax consequences at that date. But if you take a portion as a cash lump sum, a portion that will be taxable, and the biggest disadvantage is that you only really realize what the tax consequences are at the date of retirement.
Shafiq, it's always good to use an example to illustrate this. Rather than me rattling off numbers, let's take a look at this. Let's assume we have Jane and Joe, who both resigned from T-Com Communications Company after having worked there for 10 years. Jane has retirement savings of R1 million and Joe of 800,000 Rand. On resignation, Jane decides to take a 200,000 Rand cash lump sum to go on holiday and preserves the rest by transferring it into the retirement fund of a new employer. Joe, on the other hand, decides to preserve his entire savings by transferring to his new employer. So what are the tax consequences? For Joe, it's simple. He pays no tax at this stage. For Jane, the first 25,000 taken as a lump sum will be tax-free, but the remainder of the 175,000 will accrue tax at 18%, amounting to tax of 31,500 Rand. Now, this may not seem that bad at this stage, but let's explore this further. Let's roll forward a number of years to when both Jane and Joe eventually retire. After they resigned from T-Com Communications Company, both Jane and Joe joined Ecom Energy Corporation, where they remained for the rest of their working lives until they retired 30 years later. Assuming Jane has amassed another 3 million to add to her 800,000 that she preserved from T-Com, while Joe has saved an additional 2.4 million on top of the 800,000 he preserved from T-Com. This means that at the date of retirement, Jane has 3.8 million in her retirement savings, while Joe has 3.2 million. Now let's assume both Jane and Joe elect to take their 1/3 cash lump sum and annuitize the remainder as required by law. Once again, Joe's tax position is fairly simple. Since he has had no previous lump sum withdrawal, his taxable retirement lump sum will simply be the amount equal to 1/3 lump sum that he takes on retirement, being 1.067 million. This is taxed in terms of the retirement fund lump sum table. The first 500,000 is taxed at 0%, that is, it's tax-free. The total tax payable on the remainder of the lump sum will be 136,620 Rand. For Jane, the tax consequences are somewhat more complicated. Since she had a previous retirement sum withdrawal when she resigned from T-Com, this amount will be added to her total retirement lump sum. To calculate her tax, the first step is to calculate her retirement lump sum. She has elected to take 1/3 of retirement savings as a cash lump sum, so this amounts to 1.267 million. To this, we must add the lump sum withdrawal benefit that she received when she resigned from T-Com, being 200,000 Rand. This brings her total lump sum on retirement to 1.467 million, which will be taxed in terms of the retirement lump sum tax table. Of this, the first 500,000 is tax-free, which means the tax on the remaining 967,000 Rand will be 280,620. Please note that no adjustment is made for the tax she paid on her lump sum withdrawal when she resigned from T-Com, because the 200,000 is less than the 500,000 tax-free amount. This is rather punitive. To illustrate the impact of taking the 200,000 lump sum withdrawal when Jane resigned from T-Com, let's assume for a moment that she preserved the entire amount until retirement. This means at retirement, her total retirement savings would have been 4 million, 1/3 lump sum would be 1.33 million. As there were no withdrawals, the tax payable would be 232,380. However, because she did take the 200,000 withdrawal when she resigned from T-Com, the tax payable at retirement is 280,620. To this, we have to add the 31,500 tax she paid when she took the 200,000 lump sum on withdrawal at resignation from T-Com. So the total tax paid in terms of her retirement savings is 312,120 Rand. The difference between this and the amount that she would have paid had she preserved the full 1 million Rand on resignation from T-Com is 79,740 Rand in tax. This is a significant amount of tax. Not only has Jane spent 200,000 of her retirement savings, but she has also landed herself with an extra tax bill of 79,740 Rand. The 2/3 will be used to buy an annuity which will pay Joe and Jane a pension, usually on a monthly basis. The pension is taxed as if it is received as a monthly salary, which means the fund or company paying the pension will withhold PAYE from the gross pension and pay the net amounts over to them. How much tax they will pay will depend on their marginal tax rate, which in turn will be based on their taxable income. We also need to look at the effects of the 200,000 Rand that she withdrew and the compounded effect over 30 years and what that could have been over that period of time as well.
Thanks, Naweed, and let's hope Jane and Joe live happily ever after. Hugo, let's get to you. Post-retirement landscape. Can you take us through some annuity income options when a person is in retirement?
When you retire, pension funds and retirement annuity funds require you to invest at least 2/3 into an annuity. Provident funds, currently that's not the case, but that is due to change fairly shortly. Traditionally, there are two methods in which these annuities can be acquired. First of all, and that was how pension funds came about, the pension fund itself would pay that annuity to you. The second option, and which is these days the more popular option, is that the pension funds acquire an annuity either from an insurance company, usually from an insurance company, and that is then paid as the annuity over to you. Now, the annuities that are acquired from an insurance company conventionally comes in two forms. It's a guaranteed annuity and more recently the living annuities. Now, a guaranteed annuity gives you a guaranteed pension for a specified period or until death. The guaranteed annuity will let you know exactly how much you're going to get every month, whereas a living annuity, on the other hand, that is dependent on the value of the underlying assets. Now, a living annuity is required to be managed in such a way that the pension will last for the rest of your life. So there's no chance that you will, or very little chance that you will outlive your pension. With a guaranteed annuity, because it's for a specified period, there is the possibility that you could actually outlive your pension, and that is the most disastrous of circumstances. So the living annuity also gives you the flexibility that upon retirement you can leave the remaining balance to your beneficiaries, where that option is not available with the guaranteed annuities.
Now, read our final question: tax implications for a living annuity or a guaranteed annuity in the last couple of seconds.
Shafiq, from a tax point of view, there is no difference between a guaranteed annuity and a living annuity. Both of them are treated as gross income and are taxed accordingly. The company or fund that pays the annuity will withhold the PAYE and pay the net amount over to the annuitant. The company or fund will then also issue the annuitant with an IRP5 certificate, and this will stipulate what the gross amount is, what the PAYE that was deducted and paid over to SARS, and what the net amount that was payable to the annuitant. To conclude the discussion on tax aspects, Shafiq, it's always important again, and we stress this, that you need to consult your tax advisor. The examples that we dealt with are pretty straightforward and simple examples, and in reality they are going to be very different. So if you are uncertain or unsure when it comes to tax, please do consult your tax advisor.
And special thanks to Naweed Ashtiker, Wealth Manager at Oasis, and Hugo Barnard, Internal Auditor. Thank you, gentlemen.
Thank you.
Thank you, Shafiq.
You have been watching the Oasis Focus on Finance show. Tune into this show next week when we will conclude with our tax series, and we'll have some highlights from Finance Minister Nene's medium-term budget statement. Should you wish to contact us, you can call 0860 100 786 or email info@oasiscrescent.com. Until next time, Assalamu alaikum wa rahmatullah.